Good morning, everybody, and welcome to this webinar on WHEB's adoption of the FCA's new Sustainability Impact Label. So to our agenda for this morning, I'm going to give a broad overview, a very brief overview of the SDR regulations, but I know many of you are already familiar with the structure of SDR already. I'm then going to hand over to Seb Bilo, one of my partners and head of research here at WHEB Asset Management, who's going to take you through how we went about adopting the label, the changes that we've made to our prospectus, and walk you through that. Then come back on towards the end, and I'm going to talk about our governance arrangements, things we left out, and next steps and conclusions for us here at WHEB and you, our clients. So as a starting point, I do think it's worth just highlighting that impact is WHEB's sole focus as a business. It's written into our mission, which is to advance sustainability and create prosperity through positive impact investments. The label itself is only directly applied to our UK domiciled pooled fund, the FP WHEB Sustainability Impact Fund, as it's going to be renamed tomorrow, which accounts for around 650 million of our assets under management. However, all of our client accounts are managed on the same investment process and impact strategy. So this is relevant across all of the 1.1 billion or so that we manage. This is the only slide I'm going to use to give a background to the labelling regime. The labels have been available now since the end of July, and by the 2nd of December, funds need to comply with the naming and marketing rules. Though there is now an extension to the 2nd of April next year for existing sustainable funds that have already started their application to approve an updated prospectus. This is a stylized map of the investment landscape that appears in the policy statement, and I think provides a really helpful overview of what the FCA is seeking to achieve. It is complicated, but at least from the FCA's perspective, they are drawing a bright line. They're drawing a bright line between investment approaches that just have sustainability characteristics on the left-hand side and those that specifically target a particular positive sustainability outcome, those on the right. There are many reasons to use sustainability data in investments, whether to help avoid risks or to find opportunities. And different investment approaches can use this data, for example, in integration, in stewardship, or in different types of screening. But unless these approaches are specifically aimed at achieving positive sustainability outcomes, then products using these approaches will not qualify for a sustainability label, or indeed, they will not also be allowed to use sustainability, sustainable, or impact in their naming and their marketing. In contrast, products on the right-hand side will have a stated intention in their sustainability objective to achieve positive sustainability outcomes. This might be to invest in assets that are environmentally or socially sustainable, and that's the requirement for the Sustainability Focus label, or to invest in assets that have the potential to become more sustainable over time, and that's the focus of the Sustainability Improvers label, or to invest in assets that achieve a predefined, positive and measurable environmental or social impact, as is the case for the Sustainability Impact Label. And indeed, that's the one that obviously WHEB is adopting. Or a product can have a mix of all three, and that's when the Sustainability Mixed Goals label comes into play. And so that's the sort of broad sweep. That's all I'm going to do in terms of the overview of the regulation in general. I'm now going to hand over to Seb, who's going to talk more directly about how we approached it and what we've changed in our prospectus. Thanks, Seb.
Thank you, George. So as George has said, I'm going to talk about the process that we went through for getting to where we are today, in terms of both being able to use the Sustainability Impact Label, but also more fundamentally, being able to articulate an authentic case for how we deliver positive impact in listed markets. So arriving at this point has actually taken many years. I won't bore you with all the detail, but we are lucky in the sense that we are a single strategy business and have called ourselves the impact people. So really there was no choice. We had to go for the Sustainability Impact Label. But being small also meant that we could work very quickly and be very responsive to the FCA as we went through the process with them. We've been building towards this process for many years. We started really in 2021 when we set out our views on impact investing in listed equities in a white paper that we published that year. We then were part of an advisory group, one of the key members of an advisory group working with the Global Impact Investing Network on their report, the guidance for pursuing impact in listed equities. And we've got a nice endorsement here from the GIM about our contribution to that work. And then we were also one of the relatively few asset managers that were asked to join the FCA's own disclosure and labels advisory group. And so we were able to participate directly in conversations with the FCA as their thinking developed on the labels, from the discussion paper in 2021 to the consultation paper in 2022, and then ultimately to the policy statement that was published at the end of last year. And because we've focused on impact for many years and have been, we think at least, an influential voice in the codification of impact in listed equities, we already had the key foundations in place for what the FCA needed to see in order to use the Sustainability Impact Label. We've also been very involved alongside esteemed colleagues and peers in responding to the discussion paper and the consultation paper. We feel very strongly about these issues and know that many others do too. And so over the past 3 years, we've worked pretty hard and spent quite a lot of time talking to our peers in the market, to our clients, as well as to collaborative bodies like UK-SIF, the IIGCC, the Impact Investing Institute, and the GIM. And many of these groups have shared our concerns, and we've spent a lot of time building coalitions to put these messages back to the FCA. And indeed, we are still working with these groups, and in particular with the Impact Investing Institute, to build what we're calling a community of practice with our peers to support the standardization and professionalization of impact investing in listed markets. This built on the work that we did with the Friends of Provident Foundation and the Impact Investing Institute earlier this year. So we are really pleased to be in a position to start using the Sustainability Impact Label, and have been genuinely flattered by the warm response that we've received from the industry, including our peers and our competitors over the last few weeks. So in terms of the process with the FCA, something which I know many of our peers are struggling with at the moment, I think the first thing to say is that we've not had to make any fundamental changes to our investment process in order to start using the label. And it's really important to be clear about that. What we have done, though, is we have set out with more rigor and more clarity how our work contributes to positive real-world outcomes in terms of the social and environmental issues that we're seeking to solve. It was actually just a week after the FCA published their policy statement at the end of November last year that we announced our intention to adopt the Sustainability Impact Label in early December. But it wasn't actually until the 8th of April that we formally kicked off the process to amend our prospectus in line with the criteria in the policy statement. And this process of ultimately agreeing with the FCA took much longer than we expected. Took us right through until the end of August. And during that period, we went through more than 20 iterations around the prospectus and changes in writing to the prospectus. We had internal review sessions, which involved pretty much every part of the business, almost every individual in the business in WHEB's case. We've had external review processes with our authorized corporate director, Fundrock, who've been brilliant through the process, with our lawyers, Burgess Salmon, with Citi, who's the depository on the fund, and their lawyers, Evershed. So an awful lot of people to get aligned. And then, of course, we had interactions directly with the FCA as well. We had 3 in-person Zoom calls with the FCA, which included representation from their policy team, from their authorizations team, and ultimately also from their supervision team. And we had 3 rounds of written comments as well back from the FCA. And the outcome of all of this was that the key annex in the prospectus, Annex 1, increased in size from 3 pages to 15. So there was a dramatic increase in the amount of information in the prospectus, and I'll talk about that in a second. And it wasn't until the 28th of August that we received this somewhat dry and technical statement from the FCA that we have no further questions in relation to this application. And it might be a bit perplexing to people outside the process to understand quite why that led to scenes of jubilation in web. But it was a great relief, I have to say, having been through this rather extensive process. We then published the statement, the press release on the 2nd of September. We will start using the label formally as of tomorrow. And then, of course, there's an ongoing process of reporting that we have to do in order to use the label. And we'll be delivering that through our annual impact report, which will be published in June next year. So that's kind of the process. In terms of the changes that we actually made, I just wanted to run through some of these as well. One of the reasons that we were able to move quite quickly in terms of the prospectus and the label is because we, as I said earlier, we set out our understanding of impact over 4 years ago and have already had that embedded in our process, in our investment process. And the essence of this is that as fund managers, there are 2 sources of impact. The first source of impact is delivered by the products and services that are sold by the companies that we invest in. And we call that enterprise impact. The FCA have called it asset impact. And then separately from that, that's the blue bit in the diagram here. And then the second piece, separate from that, is that web also has its own direct impact through the work that we do engaging with companies in the portfolio to encourage them to improve their impact. And we've called this investor contribution, which is terminology that the FCA use as well. But that basic structure of having these 2 elements of impact, 2 pillars of impact, has already been embedded in our approach, and it is core to the FCA's understanding of impact as well. So there was immediately alignment in terms of the foundation that we were setting out in our prospectus. One important evolution in how we talk about our sustainability objective. Previously, our old objective was simply to invest in companies providing solutions to sustainability challenges. Now, the formal investment and sustainability objective of the fund is to achieve capital growth over 5 years and contribute to positive sustainability impact over this period, both through our investments, i.e. the enterprise impact, and the investor contribution, the engagement that we do of the manager. And then we've gone on to clarify in some detail what we mean by positive sustainability impact. At a high level, that means supporting a stable climate and healthy ecosystems and enabling more productive and healthy lives. And then we go into a lot of detail in the prospectus as to the kinds of companies that we invest in and the thematic areas that we invest in. And those of you that know us well will see that this is the same. These 9 themes are the same as they were previously. And then in addition to all of this enterprise impact, we also have our investor contribution, which sits around the investments that we make. That's the second piece of our impact. And then sort of apologies for a rather boring slide here, but I thought this was a useful way of showing the additional detail that's now provided in the prospectus. So we've essentially set out our impact in these 2 columns, the enterprise or asset impact, and then the investor contribution. And then the prospectus sets out the theory of change that we have around how we deliver that impact, the process that we use, and then the KPIs, the key performance indicators that we use for measuring the impact and how that connects back with our sustainability objective. So I'll just quickly run through each of those areas before I hand back to George. So this is the theory of change on the enterprise impact, the impact that's delivered through the companies that we invest in. It looks complicated, but at the top you've got essentially the theory of change, where we talk about the problems that we're trying to solve in these 9 in these social and environmental areas. We've identified the areas of the market that we believe provide solutions to those challenges, and we have our 9 investment themes. We then talk about the types of companies that we invest in, which the FCA were very keen to see. They want to see a very clear line of sight between the problems, the way in which you're investing in companies that are providing the solutions, how you measure the impacts. So those are our KPIs across the 9 different areas, and then how that relates back to the objectives that you've set. So they really want to see those objectives, how that links right back through to the companies that you invest in. And this is all spelled out in the theory of change section of our prospectus. And then we have a similar approach on our engagement. We've been much clearer here in the prospectus in terms of how we believe the engagement work contributes to our sustainability objective. And again, it all needs to lead back to that sustainability objective. And here we talk about 5 different engagement objectives, which in turn support the delivery of a positive impact in the real world. Now, for us, it's all about investing in companies that can grow their sales, grow their revenues, grow the amount of product that they're producing in order to increase the impact that they're having in the real world. So our engagement is all about supporting those businesses to maximize the positive impact, minimize the negative impact, and improve the quality of their business so that they can really deliver as much positive impact going into the future. And of course, that's largely what we want as investors. We want them to improve their impact because that also helps them improve and grow their revenues. And we provide examples of each of these types of objective, examples that are real world examples of things that we've done in order to help the FCA and our clients understand how this engagement is supporting our sustainability objective. We've also set out in more detail the investment process in the prospectus. I won't dwell too long on this, as hopefully many of you know our investment process pretty well. A key element in our enterprise impact is our asset selection process, and a key element in that is the impact engine, which sits at the center of how we identify and assess enterprise impact, and it provides a strong steer on how we select companies for investment. So I won't dwell too long on that, as I hope many of you are familiar with it, but that's a core element now in the prospectus as well. And on the engagement side as well, we have a much clearer set of what we call objective milestones that help us track progress towards our overall engagement objectives. These engagements can take months, are often even years to achieve, and so having quite a rigorous process of milestones allow us to track progress over that period, but always ultimately seeking to deliver those ultimate engagement objectives. And then finally, in terms of measurement and reporting, again, there shouldn't be too much change here for people who know us well. We've been reporting our data through our impact calculator for, I think, 7 years now. And we've been doing this really so that we can illustrate to clients how their money is directly invested in companies that are achieving these positive impacts through the products that they sell. And so that's been an important aspect of our communications with clients. Of course, now it also becomes an important part of underpinning our claim to the Sustainability Impact Label as well. And so this is an area that we will continue to invest in, and we hope to, working with the Impact Investing Institute and others, we hope to drive improvements in quality and standardization of these kinds of data. And then on the engagement side as well, this is taken from our impact report last year, and it shows the engagement objective around our work with companies on their own operational emissions is to get them to reduce their operational emissions. That's the point of the engagement. And so what we're showing here on this slide is the absolute emissions of those companies in terms of their scope 1 and scope 2 emissions on the y-axis in a log scale, and then an assessment of the alignment of their climate strategies with the Paris Agreement on the x-axis. And our objective over time, of course, is to increase the alignment with the Paris Agreement, but ultimately the objective is to reduce their emissions. And so we will track that year on year to show how our companies hopefully are able to reduce their emissions. We are careful not to claim that these changes are solely down to WHEB. That would, we think, be absurd. but we certainly believe that we are making a contribution here through the engagement that we do. And again, this is an area of pretty rapid innovation in terms of reporting, and we'll be publishing more on how we think about stewardship and engagement in a white paper coming out towards the end of October. So I hope that's been helpful, and I'll now pass the microphone back to George, who will finish the presentation.
So thank you, Seb. I'm now going to briefly talk through the governance requirements that are required as part of the new regulation. And I'm also going to touch on some of the things that we've left out before I then move on to next steps and to conclusions. So we have had an independent investment advisory committee at WHEB since the strategy was originally founded nearly 20 years ago. This group has always had a governance role in that the team have had to justify the inclusion of every stock in the portfolio to the committee as being consistent with the aims and objectives of the strategy and the consistent application of the process. And for the past 12 years, we've also published the minutes of this meeting, which gives the committee increased credibility and transparency in performing this oversight and governance role. We are required under SDR to have independent oversight of the implementation of the policy and the sustainability objective. And we do this both internally, where we have our investment and risk committee, which is independent of the investment management team, and also now externally by using the investment advisory committee, which scrutinizes the investment manager's activities, including stewardship and any changes to the KPIs. And to support the enhanced role of the advisory committee under SDR, we adopted new terms of reference for the committee in July this year, and we've now asked our authorized corporate director, Fund Rock Partners, to join the committee to facilitate their oversight responsibilities as well. So that's the governance process around the strategy is based on the framework we've used for many years, but has been beefed up in order to meet the requirements and the aims and the requirements under SDR. I also wanted to touch on some of the things that we've not included in the prospectus and the things that we've left out. The standards required if you're going to make claims under SDR represent a very high bar, and we've been careful to pick our battles in this respect. So although we strongly believe that our investment activity through mobilizing capital towards the impact economy does have an impact as of itself, and we also feel that our work on client engagement has a positive impact, as does our contribution to at a systems level, for example, in terms of market framing and policy engagement. And WHEB's whole organization's sense of purpose and mission is important to us and our clients, and we will continue to work hard to make a positive impact here. However, the outputs and effects are complex and difficult to measure, and certainly to measure to the standard required in the policy. And equally, we feel that our impact engine is a detailed and systemic framework that should be regarded as a robust and evidence-based standard of sustainability. However, for the impact label, the Sustainability Impact Label, we don't need to claim this as part of the requirements. So for all of these points here, we haven't pushed to include these things, and they're not included in our prospectus in terms of or our claims around the label. So the label goes live tomorrow on the 20th of September, at least for WHEB. And the first thing that we're going to do is to change the name of the fund. Not a lot, but adding the word impact to the existing name in order to align with the label. So the fund becomes the FP WHEB Sustainability Impact Fund. Tomorrow, there will also be 2 new documents available on our website. Firstly, the updated prospectus, which I'm certainly judging by the number of people on this call, I'm anticipating will have a very high download rate from others who are working towards a label. And also the new consumer-facing disclosure, a 2-page document, further screenshot on the right-hand side of this slide, which summarizes key aspects of the label. We've worked very closely with ESG Accord and I'm very grateful to them for their help in getting this particular piece ready. We've been aligning our impact reporting with the expectations for SDR already over the last couple of years. As Seb said, having written that white paper in 2021, we've just framed a lot of our reporting around that structure for some time. However, next June, we'll see our first impact report, which will be published with the regime in operation. And to contribute to finding, so one of the challenges that Seb has already mentioned is that the harmonization of reporting remains an area of significant concern for the industry. And to contribute to finding solutions to that particular challenge, we're working with the Impact Institute, Impact Investing Institute, to convene a community of practice to explore ways of aligning reporting and reporting techniques so that they can be better targeted and more comparable between different providers. And we hope to remain very engaged and play our part in helping to see the SDR framework extended successfully, both to model portfolio service providers and to other markets, which we expect to come into scope eventually, for example, the pensions world. The FCA's objective with SDR is to firstly support and protect consumers by helping them make more informed decisions when investing, and secondly, to enhance the credibility of the sustainable investment market. There has been, over the years, some degree of confusion in the market about the expectations of different sustainable investment products and strategies. But with the new labels, it will become simpler for investors and their advisors to navigate between different approaches, and the structure of the regulation should mean that we get closer to products doing what it says on the tin. There is much greater disclosure under SDR. As Seb said earlier, the relevant annex for our prospectus has become much longer, possibly too long, but there is also the shorter 2-page disclosure, the consumer-facing disclosure I just mentioned, that sits alongside, and that is much more accessible and clearly digestible for consumers. Ultimately, what we all want and need is to see more capital being mobilized towards achieving positive real-world change. And we think in time that the SDR labels will come to be seen as a key step forward towards achieving this objective. I'm going to finish now with a plug for our annual investor conference at the end of November. This is a half-day event which will be held at REBA in Portland Place in London. We have some brilliant external speakers, and it's also a good chance to meet the whole WHEB team and get a good feel for what we've been doing in the fund. But this year, we'll also be holding a panel discussion on SDR specifically. I'm very optimistic that by this stage, we'll be talking about it against a background of accelerating momentum for SDR and increased adoption by funds. And we'll be starting by then to see a steady stream of funds adopting all 4 of these labels. So I hope this has been a useful overview for people. And we've got some good amount of time now that we've left over that will bring Seb and Susie back on. And we'll have time now for your questions. And I can see from the question deck that there's some questions starting to come through. As a starting point, can you talk at the top end? The sustainability definition requires that a broad range of different aspects of sustainability must be covered. Or is it sufficient to be sustainable in a single area, but in a well-defined manner? Could one be sustainable, but only for, say, some defined social issues and not for other things? So I guess, I think a lot of the answer is that the FCA almost prefers it to be specific than to be diverse, but just give us some reflections on that.
Yeah, I think it's certainly easier to be specific. I think, well, I'd hope the FCA are kind of agnostic as to whether you're covering one thematic area or multiple thematic areas. It just makes it more complicated to cover multiple thematic areas. I think what they want to see, though, is a clarity around the sustainability objective, clarity around how the process delivers against that sustainability objective, and clarity around how you measure the impact. So yeah, absolutely, they're absolutely keen to see all those types of strategies, but you just have to be very clear.
Yeah, sure. There's a sort of related question about aggregating impact metrics at the portfolio level. And you just talked through our impact calculator and also our methodology for KPIs around engagement. I mean, clearly there's aggregating metrics that cover companies doing different things is a challenge, but that's something that we've addressed over a number of years. Do you want to just touch on that question?
Yeah, it's a good question. I mean, we invest in a variety within our health theme, for example. We invest in a variety of different businesses, treating a range of different conditions. And it's at one point, for example, we were reporting the number of COVID diagnostic tests that our portfolio businesses were producing. We reported that as a separate indicator during the pandemic. It felt appropriate to have a separate indicator on that issue. But otherwise, we do aggregate the numbers under quite broad categories. So in healthcare, it's the numbers of patients receiving treatment without actually qualifying what that treatment might be. We've talked about communicable and non-communicable diseases, so we could break it down. But we also want to make sure that we're not reporting, 40 different indicators. I think that would become unmanageable for clients. So there's a balance to be struck in terms of aggregation and granularity around the data that we're providing.
Okay, great. So just there's a few questions coming through around engagement and the kind of investor contribution. Is the engagement element a firm requirement for a public markets impact label, or do you believe you would have been granted a label based on the asset impact alone? I guess that's a good place to start in terms of questions on the investor contribution side.
Yeah, no, it's absolutely clear that just investing in assets that themselves have a positive impact is not sufficient for the sustainability impact label. You absolutely have to demonstrate that you are also contributing to positive impact through the work that you're doing as your investor contribution. That's a kind of non-negotiable. You have to be able to demonstrate both of those things. We had another question asking us as to why we thought we'd been successful and others haven't. That's a difficult question to answer because we're not privy to the applications that other managers have made. I suspect perhaps so that may be part of it, that people haven't sought to deliver against both of those objectives and are now having to think about whether they want to invest in the resources to deliver on that investor contribution. But yeah, absolutely clear that you need to have both for the sustainability impact label.
Yeah, and there's been quite a range of questions about the sort of engagement side in terms of, I think you've addressed a lot of this, but just there was one question about the difficulties we might have encountered ourselves in terms of meeting the stewardship disclosure requirements. For example, around escalation plans. I do just touch on that it's worth just touching on that in terms of our engagement processes. But also, I think one of the things that came through in terms of how we measure the effectiveness of our engagement as well, just worth touching on that side as well.
Yes, so I mean, I'm not sure what I can say about escalation processes other than that was something that the FCA wanted to see evidence of, that you have an escalation process, that it's time bound and that sort of thing. We didn't have a huge amount of conversation, if memory serves, around that. They were happy with what we set out. Everyone can see what we set out in under 24 hours. The other piece you mentioned around measurement of our contribution. Yeah, so we sort of debate this, I think, with peers around that question. I mean, our view is that it's really, claiming causality in your engagement is extremely difficult. I'm not going to say it's impossible, but just extremely difficult, and in most cases not really credible. Companies make decisions for all sorts of reasons, not just because one investor tells them. They make decisions because investors generally are telling them something, customers are telling them something, employees are telling them something. So I don't think it's really helpful to seek to demonstrate causality. I think that's an impossible standard. I think the FCA certainly understand that as well. And so what we are sort of seeking to do is focus on the ultimate objective, which is real world change. The objective isn't to write letters. The objective is to see some real world change. Focus on that, and then you can document the activity that you've done to try and deliver that. And that's kind of how we've approached that, and then using our milestones as a way of demonstrating some progress towards that objective.
Yeah, and I think the other thing that we came through the progress, as you described in one of your slides, we needed to set out both the theory of change and the process and how we report the KPIs for both the asset impact and also the investor contribution. And so clearly our KPIs around the asset impact have been developed over many years in terms of our impact calculator. Developing those the process and writing down the methodology for the KPIs around the engagement process has been quite a useful exercise, I think, because it helps us to frame and target very specifically the objectives that we're trying to achieve with each engagement and relate them back to the objective we have for the fund as a whole.
Mm-hmm.
There was another question. I know we're sticking a lot on the questions around engagement, but it's useful maybe to wrap them all up together at the same time. There's one question saying, would we consider engaging to improve company disclosure as an investor contribution, whilst it's not a direct impact in of itself, it does facilitate some engagement objectives, i.e. Tracking positive, negative impacts, so you can engage to improve or reduce them.
Yeah, we see that really as a step towards the ultimate objective rather than an objective in itself. So, if you look at the milestones that we've set out, one of them is around acknowledging the issue. Then there's one around agreeing to disclose or actually disclosing information. So that doesn't actually, just because you're reporting your carbon emissions doesn't mean that you're actually reducing your carbon emissions. It's a step on the road. You can't really deliver reductions unless you're measuring it. Yeah, we wouldn't see that as an ultimate objective.
Yeah, and how central was the issue of divestment to your engagement approach? Should an asset fail to achieve your stated aims?
Well, that's something that's specifically stated, but it's not. That divestment is an option that we have. I can't remember everything in the prospectus, sorry, but I'm pretty sure that it's just stated as one of the outcomes. I mean, ultimately, we see that as a failure of our engagement. If we've had to divest the stock, then it's because we've been unsuccessful in getting the business to change in the way that we think it should. So that's a failure. But yeah, it certainly has to be there as one of the outcomes ultimately that you one of the sort of one of the outcomes that happens as a consequence of your engagement.
Thanks. So then there's a number of questions about our KPIs towards the impact metrics in the calculator. You talked a bit about aggregating, so there are a number of other questions there. One in terms of there was a question, I've just lost it slightly, that do we require every asset that we own to report against at least one of the metrics? So the key elements around measurable KPIs, we've outlined a set of KPIs to enable us to measure enterprise impact. Is it a requirement for all companies we invest in to report against at least one of these metrics?
So the FCA don't require you to report at asset level on these metrics. They only require you to report an aggregated number. There was also another question I think we've had about estimation as well. We've made a huge amount of progress in terms of the quality and extent of impact reporting, impact of products and services over the past 5 years, but it's far from perfect, and so we do rely on estimations for the data. We use a third party. Having done this ourselves for the first 5 years of our reporting, we now use a third party, which is referenced on the slide in the deck, and they use estimation methodologies. We certainly have ways of assessing impact for all of the companies that we invest in. I think people would quite expect that of us. We don't in all cases have the ideal indicator for that impact, and in fact that's one of the things that we engage our companies quite a lot on, is trying to get them to improve the quality of their reporting around impact. So that's absolutely an ongoing project, but we've made enormous progress in the last 5 years, and believe that it's now at a point where it's reasonably robust. I wouldn't say it's perfect, but it's reasonably robust at this point, I think.
Okay, thanks. There's a question saying, talking about sort of definition of the labels, I think, really. saying it seems like enterprise impact is very similar to the sustainable focus theory of change, and your investor contribution is the same as the sustainability improver theory of change. Did you consider the use of the mixed goals label? So it's kind of like, do you want to take that one as well? There are a couple of others in terms of how we approach the theory of change as a starting point, and how long we clearly set out our own theory of change before SDR came along. How much did we have to change that in order to fit with the requirements of SDR?
Yeah, I mean, I guess we've been so focused on the sustainability impact criteria. I've not spent an awful lot of time going into the weeds around the focus and improver category. I mean, as I understand it, I mean, the differentiating feature of the impact label is that you're delivering, real world change through the companies that you're investing in, and then obviously you have this investor contribution as well. I think the focus is more around leaders in any sector really that have made significant progress or can claim to be operating sustainably in a particular area, say carbon emissions. So that would include businesses like Microsoft or Unilever, for example, who don't really have a product, or in our view don't have a product that's delivering a positive impact, but maybe run their businesses in a way which is very sustainable. That's quite different from what we're talking about in terms of impact. So that's, but yeah, I wouldn't claim to be an expert on the focus category. So it may be that there are other dimensions that I haven't really appreciated.
But I think it relates back to there's a very technical question that's been asked along the way, that if our impact engine isn't our AREBS, then what is? And I think by AREBS, AREBS, is meant the absolute and robust evidence-based standard of sustainability. So I think that the people are moving into all sorts of acronyms here on SDR. But the point I was making about the impact engine there is that under under the sustainability impact label, we aren't required to have an absolute and robust evidence-based standard of sustainability in our claims around using the label. We believe that the impact engine is that standard, but we don't use that as part of our claim because it's not required within the impact label. That is the point that we're trying to get to with the impact label is the real world change. With the focus label, the focus is much more around assets that are already at a level of sustainability, and that may be about their operations as much as it is around their product. And that's I think the core sort of point to prove, if you like, within using the focus label is that absolute and robust evidence-based standard of sustainability. And so that is a particular challenge that relates to that label, whereas in the improvers label, it is much more about assets that may not be sustainable today, but have the potential to be sustainable, and the investor contribution that is working towards those assets achieving that potential. So that hopefully that answers that question alongside the one that you've just been answering there as well. So I'm sort of trying to scroll around. Are there any others said that we've missed out from? There are a few about I guess the process, the adoption of the labels, and sort of interoperability with European standards, which may be more for me to answer. There is one about the interoperability with SFDR. I think this is a key challenge for the industry, and the regime at the moment is and particularly will become so as we move into talking about the model portfolio services and how they apply there. We hope that we will over time see a move towards greater interoperability between the two regimes, but that is obviously there is a consultation ongoing around SFDR, and there is also, we're waiting for the results in terms of model portfolio services as well. So at the moment, I think that is a challenge and an issue that needs resolving, and we hope that that those two processes will move towards doing that, and we hope to play our part in doing so. There's also been a lot of comment. I was going to pick up a couple of questions about other. We've seen quite a lot in the press over the last few days about either models for portfolio service providers or other fund managers moving away from using the labels, which clearly we're disappointed to see that. And we hope, though, that as we see more precedent set, that it will become clearer for others as to the path towards achieving a label. As I said, we expect when we publish our prospectus tomorrow, to be downloaded vociferously by others in the industry, because it will show a map of something that has achieved or has been approved in terms of the process towards adopting a label, and so it will show a path that works, and others, I'm sure, will show different paths that work as well alongside. I think as those precedents become set, we will start to see an ease in the kind of logjam towards getting other products prospectuses approved in the process, and other products coming forward and starting to adopt the labels, not just the impact label, but the other labels as well. It's clearly in everybody's interest that we see a market develop so that they get used, and so that we actually see the ultimate objective, which is that consumers benefit from the labels, and that the market grows, and we see more capital being adopted or mobilized towards the purposes of solving some of these challenges that we see from a sustainability perspective. So at the moment, there's a lot of funds. There's a question that's come through about the logjam, if you like, of 4,000 funds trying to become approved. That is clearly a challenge, because there's a capacity challenge. But we do expect over the coming weeks, and I hope certainly by the time of our conference in a couple of months' time, that we'll have seen some progress in that, and we'll start to see that having eased somewhat.
Yeah, I mean, I mean, we have a few minutes left. There are two groups of questions as well that I've just sort of spotted in the list. One is around transitioning and the importance of transitioning, and kind of the comment that that's not really accommodated in our approach, which is true. We're not investing in transitioning businesses. But that's not to say that we don't think that's what the improvers label's for. It's about getting businesses to transition, and we think that's absolutely credible, really important, and we absolutely welcome other strategies focusing on that. It's just not what we do. So I hope that helps kind of clarify where we sit on that question. The other question is around theory of change, and at what point did we articulate our theory of change? We have this tool, our impact engine, which is really all about intentionality and being very clear about what the theory of change is at a stock level. And in fact, we think that's kind of almost the most important thing. We are super clear about why we invest in a business and why we believe that's going to have a positive impact, and we have a clear theory of change articulated there. The FCA wanted to see a theory of change for the fund as a whole. That was their lens. And we talk about nested theories of change. We have at the stock level, we have it at the thematic level, and then we have it at the fund level. We've not been particularly explicit about the theory of change at the fund level. It was always kind of implicit, and I think this process has asked us to be much more explicit about that theory of change. And so we've been able to do that. And as I said, we published it in our impact report back in April or May. But it's always been rooted in the stock level analysis, and that's been the case for 4 or 5 years now.
Very good. There's one question about how much notice we provided to investors on the changes to the prospectus, including the label and name change. And I think the point that hopefully we've made several times through this webinar is that we've not changed anything in terms of our investment process or underlying what we're trying to achieve or our objectives with the fund. So there's no, and the regulator agreed that there was no fundamental change as a result of that. The prospectus and the process around SDR has really been about clarifying and providing more information alongside. So we didn't, it wasn't defined, we didn't define it as a significant or a fundamental change, which means that we didn't need to provide any notice. So it was a notification event rather than one that required a notice period. We did give a bit of notice because we were changing the name of the fund as well, and it takes the various other parts of the value chain in terms of platforms, our transfer agency and the like, just a little bit of time to put that in place. So we allowed Hence there's been a bit of a gap between when we announced that we were adopting the label and when we're actually doing so tomorrow on the 20th of September. But it wasn't a requirement to provide a notice period from a regulatory perspective, so that was fun.
I think it's probably worth just also saying that compared to SFDR, it feels pretty painful at the moment with the SDR. I think that was always likely to be the case with a principles-based approach. We're all trying to work out what the FCA means by those principles. The fact that we've been able to get through the gate, as it were, with our fund in listed equities means that I'm sure others will be able to as well. And I think ultimately in the medium term, it'll provide a much more flexible regulatory framework that allows fund managers to innovate and develop new strategies, and will in the long run mean a much better framework than a very prescriptive one like we've seen with the FDR, which really doesn't have any scope for change at all. So although peak pain is probably still with us, I think our expectation is that things will improve from here, and that will ultimately be a better outcome over the long run than the prescriptive approach.
Great, thank you. So that seems, we're just coming up on the hour now. That seems like quite a good point, really, perhaps to bring the call to a close. We've got an awful lot of questions. I'm sure we won't quite have got through all of them. We've been trying to jump around a list of 50-odd questions, and I think we've covered a lot of them. And we're very grateful for all of you for dialing in. As I say, it's been about the most popular webinar I think we've ever done. And hopefully that is, as Seb says, a great marker for the ongoing interest in these labels. And we'll see more funds coming through. We're happy to work with other people. We want to work with the industry to see this be successful. And that doesn't just mean our peers. It's also down into the value chain as well, with you, our clients, with advisors and intermediaries and platforms to get these labels into a position where they can help consumers get to the products that meet their needs in the best way. So thank you, everybody, for dialing in today. It's been a pleasure to have you. We'll try and follow up with any specific questions that we have missed separately, or do email it into us, and we hope to continue this dialogue and see these labels adopted in a successful way. So thank you. We'll draw it to a conclusion there. Goodbye.